Navin Fluorine recently shattered its own records, hitting an all-time high of over 7,200 rupees a share. These earnings explain the momentum. The company posted a net profit of 213 crore, operating at an impressive 34.3% margin. This quarterly report solidifies the growth story, with a 41% increase in total revenue. While these metrics suggest an unstoppable business, institutional investors are becoming increasingly cautious. This gap between public hype and private caution raises a critical question. Is this a long-term winner or a carefully set trap for late buyers? In the stock market, a flawless surface narrative often functions as the mechanism that draws retail investors in at the very peak of a cycle. The current excitement stems from a massive business transition. Navin Fluorine moved away from low-margin commodity chemicals to become a high-margin contract manufacturer for global pharmaceutical giants. This transition created an aggressive earnings flywheel. With their manufacturing plants already built, scaling up production to meet these new pharma contracts triggers significant operating leverage. Margins expand and profits surge without a proportional increase in capital spending. This price chart shows the result. We're looking at a consistent exponential curve upward since 2017, proving this isn't a short-term trading fluke. Navin Fluorine has transformed into an elite, fundamentally sound business, which justifies much of the market's initial optimism. However, identifying a high-quality company is a different calculation than identifying a high-quality investment. This chart tracks the company's price-to-earnings ratio. While the historical median PE sits at 23.3, the current valuation has spiked into a range between 60 and 80 times earnings. The EV to EBITDA chart confirms this deviation. The historical baseline is an 11.8 multiple, yet the current peak has soared above 40. At these multiples, the market is no longer paying for current results. Buyers today are essentially prepaying for 2 to 3 years of absolutely flawless future execution. Buying into this level of overextension leaves no margin of safety. If the company misses even one quarterly projection, the valuation is positioned for a significant collapse. Data on smart money behavior shows a clear contrast to the current retail excitement. These delivery percentages show that institutional players were quietly accumulating large positions from December through April, long before the recent price breakout. Compare that early accumulation to these steep vertical green candles on the right. This represents late-stage retail buyers rushing in as the trend reaches its most expensive point. Institutional investors are now riding the momentum they built at lower prices. They're waiting for maximum public hype to quietly distribute their shares and exit their positions. This liquidity map shows the current price of 6,821 is boxed in. It sits immediately below the R1 resistance level of 6,843, with the pivot point providing support at 6,734. We can use this to establish a strict entry framework. Anything above 6,800 rupees is the red zone. Entering here means paying a massive premium for perfection, where the risk far outweighs the potential reward. The yellow zone between 6,200 and 6,500 offers a better balance. This is where the company's valuation logic aligns with primary technical support levels. The green zone between 5,800 and 6,200 represents the panic correction area. This is the range where smart money is most likely to re-enter the stock. Watch the delivery percentage closely. If it drops while trading volume remains high, it indicates that institutions are liquidating their positions into the retail rally. Profit potential in high-growth chemical stocks is dictated by entry discipline. Buying even an elite business at the wrong price can stall your returns for years.